Hello, ladies and gentlemen. It's a financial show, Modern Financing. My name is Sasha Star, and I would like to introduce my esteemed guest, Peter Bennett, who is a professional from Wall Street and graduate from New York University. Welcome to the program, Peter.
Hi, Sasha. How's everything?
Okay, everything is fine. Very interesting things are happening on the stock market, as you know. And uh, of course, we still have preference for high-paying yield dividend stocks. It's a core of should be a core of investment portfolio for many of us, if not all of us. It depends on your view on the market. But
And selling options. Don't forget about it. And selling options, right?
and selling options, of course, now when the market is really uh, it's indecisive territory where it's still there are so many reasons for the market to go much higher than it is now, but there are a lot of reasons for it to drop, at least on the short term. So we are trying to do our best to figure out what's happening. But there are two stocks actually caught my attention for trading purposes only.
Oh,
One is Snap, and another one is DWAC. And it seems to me that, first of all, let's talk about Snap a little bit. What I've noticed is that it's lately was trading at around $75 level, and today is hardly 52 something. It's dropped due to the latest earnings report, which was a disappointment. And now I've noticed that Cathy Wood picked up on Monday and Tuesday a lot of shares of Snap.
no, she
Uh,
liked it.
she likes it, but well, at this level, in my opinion, uh, based on what I've seen before, and I've seen a lot, it seems to me that there is a huge gap created between 75 and 52. Normally, stock have to get back at least half of this to fill this gap. So in the short term, I wouldn't be surprised to see Snap moving to 60, maybe $65 territory.
Hmm.
And from then on, nobody knows what's going to happen. So maybe that's why she picked up some shares, or she loves the company, or any other reasons. So what I did, I sold some puts on
Oh,
Snap. Just it's risky. It's not your average company and Microsoft or some kind of solid like Google and others. It's a much riskier proposition. But
yeah, especially today because of
especially
what's going
today,
on in the markets. There's been, the stock market's up a lot, and the QQQ, the Nasdaq, is up. They're all at all-time highs, basically. But there's been a rotation, and Snap was down 25% last
yeah,
week
that's
on one
right.
day, and Facebook's been going down a lot, and Google's, I think, being hurt by a lot of different things going on. First of all,
Yes,
Apple changed its privacy rules, and they are now offering people an opt-out, and they're finding a very large percentage of people are saying, no, I don't want you spying on me. I think it's somewhere around 75%, maybe it was 80, whatever, but it was very high. So then all these companies that rely on advertising, maybe on an Apple iPhone or whatever, um, and in other places, as these privacy rules are change, now they lose their avenues for exposure. So that hurt a lot. Additionally, of course, there's a lot of political pressure on some of these stocks, like Facebook particularly, because more and more is coming out about how they influenced the election, they influenced it. First of all, I was reading an article today. It's unbelievable how they censored things that should have been allowed to be mainstream. There's also, I've always had a suspicion that the $400 million that Zuckerberg gave to community organizations went to basically nefarious purposes in terms of changing the election results. I don't know if it did or not, but there was a lot of corruption in this election. So all these, but still QQQ climbs higher because then people move towards Microsoft, which is one of, the ones I've sold, Amazon, which won't be hurt as much by these changes.
Absolutely.
But there's a lot going on with the QQQs right now.
Yeah, yeah, that's a very interesting environment. It seems to me that Microsoft is really insulated from all this. Amazon, that's another one. You are absolutely right. With the Snap is
You
much
don't know.
easier, but could be potentially a better proposition. It's really hard
Did
to
you
say.
protect yourself under the puts, or did you
Yes.
just do
No,
naked puts?
no, I protect it because
Oh, okay.
Snap can go back to $15 a share just quite easily, where it was a year.
Fibonacci theory, which is basically a lot of people would understand that, or you can look it up, but basically is that it will go up back, recover maybe a third to 2/3, or at least maybe on average 50% back. So it could easily snap back on that. I don't know if I do that or not, but it's an interesting trader. But I'm such more of a long-term investor where I just want to buy a nice dividend stock and just hang on, or sell an option and hang on and just make
So
my money.
Snap is a purely trading
Yeah, it's
situation.
speculative. Which
It's
is, talking about speculation, that you mentioned one other stock, and I did take 1/3% of my portfolio in DWAC
yes,
because it's digital world. A lot of people may know it, but it's basically Trump's new venture in the internet world. And the way I view it, I mean, it may bomb, but it could also, the market cap now, I can't quite figure it out, but it's maybe $1 billion, 2 billion, somewhere in there. But it could also turn into $1 trillion company over the next 10 or 20 years. So, because he has 100 million people who want to follow him. And I don't think they'll have trouble getting advertisers because, first of all, a lot of the advertisers aren't even big companies. They're rather people who are just trying to sell things to people, and it'll be another ad. So, it popped up. I got it around 70. Then it popped up to about, I don't know, 140 or 130. Now it's
yes,
back at around 67 or 70. But I'm holding the 1/3 because, I look at the expected value. If I lose 1/3 of percentage of my portfolio, I'm really not going to be hurt very much. But on the other side, this thing could be 1,000-timer in 10 or 20 years. So, or 500, times, whatever. And so it's a good stock, and it's a lot more solid than, a GameStop or AMC, where they're just struggling, the underlying companies, where this really is totally speculative, but it has a lot of potential.
my take on this stock is number one. It's, at least for now, it's a trading opportunity more than anything else. And a couple of days ago, I shorted the stock at 108 and
Wow.
and covered myself at 76. So
Oh,
this,
okay. Oh, nice.
well, I regret that I did only 1,000 shares. I should have done much more. But anyway,
Well, but it's speculation. You know what? Maybe it goes up to 200. Look, if it follows like some of these other meme stocks, it could go just not even based on fundamentals, and there could be solid fundamentals here,
no,
especially.
but I'm not talking about fundamentals at this point.
No, I know, but I'm just
Trading.
saying it's risky to do what you did. So you did
Uh,
it. You
well,
made
my point is the
money.
same thing with the Snap. Okay, so this stock went in a matter of days, if not hours, from $10 to 130.
I know.
So there is a huge gap that usually it has to be filled somewhat. So I expect that it should go down to at least 50, maybe $40 a share, and then it could go much higher. But again, it's all theory, it's all speculation.
Yeah, that's theory. This is not a theoretical stock where you can apply Fibonacci to, because
True,
look,
true.
there are a lot of people who might say, first of all, it's a meme type stock. So people might say, you know what, I want to put in $1 because it might be worth $1,000 net later, and I'll just hang on, like me. I mean, look, I'm not putting in my portfolio, but it's a good expected value because I think it's 30% that it's going to be up a ton, maybe 50% it'll be up, maybe even in 10 or 20 years, maybe up 500 times or 1,000 times. So a small amount of money can turn into a lot of money. So I don't know if a lot of people will be selling. Some people are shorting it now. I read another person saying they're shorting it, but those shorts, they'll chicken out if there's any pressure on it. So I think it's
Right.
very smart.
You're absolutely right. If you go to $200 a share, there will be
Yeah.
some
Yeah,
shorts.
the shorts will run for the hills right away, and it's so volatile.
Absolutely.
So,
So
and the
right.
other thing is the shorts will be wanting to get out of their positions as soon as they can if they make good money like you did. So, I mean, I don't usually, yeah, it wouldn't be a stop at short or long for, I mean, I'm sorry, as a trade. I think it's just an interesting long-term hold to me.
Well, right now I'm looking for a long side of it, but I think there will be opportunities probably between $40 and $50 a share.
Oh,
I
well,
would I would look to get long position.
yeah, well, then
See,
I'll lose a little bit of money in it if it goes down to
now,
50. Right?
interestingly enough, there is another point of view on the stock. It's a political stock. So
Oh, yeah.
people who love Republicans and of course Trump himself, there's a good point for them to own the stock because if all this will materialize, so we're talking about a few things. Number one is that Trump will actually be able to create this company uh, which will compete with Facebook and probably even close Facebook forever as
Yeah, well, he
building
could
it.
hurt them a lot, Twitter, Facebook, and stuff. And by the way, you know what? Some people like, oh, some people who don't understand anything and get their news only from liberal sources like CNN, really unreliable because it's so one-sided. But they think, oh, Trump failed in so many things and he went bankrupt. But actually, I forgot the exact numbers, but it was something like 87 ventures that Trump's been involved in over the time, and some like Atlantic City failed, but it was a very small minority. It might have been like six, maybe three went bankrupt, six failed, but a lot of those ventures did tremendously well. And he has, a huge potential. I mean, he has, as I said, 100 million people audience built in who are following him on Twitter. I think it's 100 million, somewhere in there, and a lot of supporters. And people will be curious, and also people might be angry at Facebook now because of all their not only political wrangling, but because of what they're doing with kids. Because now there's a lot of feedback that they ignored rules that are hurting kids on Instagram and images and they don't really care. They're like Nike. They don't have any morals. They're just interested in money basically, and it's sad but true. And so a lot of people may say, you know what, I'll try the Truth Social Network, and some people won't.
But the main point is that it's not there, and it's not going to be there for foreseeable future.
What,
This
the
is,
actual network?
yeah, the actual network.
Well, they'll build it. I mean, I bet it's up and running in a year or so, I would guess. I
uh,
haven't read how long it'll take, but I would think even less. And you know what? The Trump kids can continue it. So yeah, it's the technology's there, and and I think they'll figure it out. I mean, I've always said Trump should do this because this, and interestingly, his arch enemy Scaramucci, who was a friend and now is a terrible enemy, and he's kind of not too. I wouldn't say he's not
oh,
bright,
he
but
runs a hedge
he's
fund.
so emotional, and
Yes.
I don't think much of him at all. But he says, "Oh, this is good because Trump will get involved in this and maybe stay away from politics," which I kind of like. Even though I like Trump's policies, I think that Republicans could come out with a stronger candidate in 24, and because the media spent so much time attacking Trump on his personality, so they don't have to talk about the issues. But it's going to be hard for them to build up that hate quickly against another person who says, I'm going to follow these policies. So we'll see. I mean, it could go anywhere, but I'm not selling a share because, again, it's a third of a percent. It may be 50% of my portfolio in 10 years or 20 years, and maybe 100, or maybe, or maybe zero. But if I lose a third, it's fine. But if you look at expected value, I like it because I think there's at least a 50% chance that it's going to be huge. And so, as I said, they can play. I'm not a trader mostly, so I'll just hang on.
Yeah, for a long term, hopefully it will work. Now, as talking about Trump's potential presidency in 24, I think two things have to happen for somebody else to become a president from a Republican Party. Number one, Trump has to make it clear that he's not going to run. Because if he runs, I don't think anybody will challenge him.
I disagree. I
You
think
see?
that I think it may be true. I mean, it'll be hard for somebody, but I think somebody like a DeSantis, who I think could easily be the next president, could slip in there because there was initially a CPAC poll, a conservative organization, and initially DeSantis won, and then later Trump won. But you know what? I don't know, but I'm hoping Trump will say, you know what? I can have power through the media, and we can do better with somebody who loves my policies almost exactly. I mean, I don't agree with all of Trump policies for sure, but compared to what Biden's doing, and the Democrats are crazy right now. I mean, most of their policies, they have some good ideas too, but mostly it's insane. I think whoever runs is going to get killed on the Democrat side, 22 and 24. It'll be interesting what happens in this next governor's race, although that doesn't prove anything. But Virginia,
My point is that first of all, he has to announce that he's not running, because I don't believe that if he's running, somebody can seriously challenge him.
I'm saying I think they can.
You
Yeah,
think so, yeah?
yeah, I think DeSantis can, but we'll see. But I mean, I'm saying I'd still say Trump will be the favorite if he runs. But 24 is a long time off. You know what? I want to talk about the markets. It's an interesting debate going on because Jack Dorsey from Twitter, who again I'm not a big fan at all. He's a little strange, especially if he's running a big business. But he came out with the markets and said he thinks there's hyperinflation. So, and then this week also, Kathy Wood, who had a tremendous performance last year in ARK, and
Yes.
and this year is not doing as well. But I've listened to her, and recently, I mean, the last 2 weeks, I heard her just talking about different things. She's really bright, and she's saying, no, Jack Dorsey's wrong. There's not going to be hyperinflation. And I want to say I totally agree in the long run with Kathy Wood, because there's 2 points. And so I think if you're an investor, you have to say, though, I believe there'll be moderate inflation. I know that seems safe, but I think there's going to be some inflation. But I
It's
think,
already
well,
it's
yeah,
already
but no, I'm talking about for the long run. So I don't think it's going to threaten. I think it'll scare the market in the next 6 months to a year because rates might come up. Although today, the 10-year went down to 1.55. And the
Yeah.
market is acting just like we're in a long-term yield desert, because there's a lot of cash out there. And and the way I view it, maybe a lot of investors do. Look, maybe I'm 50% bonds, 50% stocks, whatever it is. If rates come up for my retirement, that's a good thing because I'll make some money. Right now, I was lucky to have locked in rates, muni bonds at 2%. If it stays the way it is, and they were some very safe ones, North Carolina, different state bonds, but when they expire in 8 years, as an example, I'm just one investor, but then I'm looking at, if rates come up a little, maybe that's good because I won't be getting 0.5% on my bonds. But I better have a lot of dividend paying stocks to make up for the fact that those bonds are going to get creamed. So it's a balance anyway. But here's 2 points about this. It was interesting. Well, this was from Barron's this week. It says, in particular, the 70s were very different from today because inflation was embedded in the behavior of businesses. The real rate on 10-year inflation protected now is 0.95%, which is an anticipated inflation rate of 2.62%. So the Treasury market is basically saying they don't expect more than 2.6% inflation over the next decade. And I think it'll be a slightly higher, but not much. And then it also says the difference between now and then is the Fed is anchoring short-term rates near zero while continuing to buy treasuries and agency-backed markets. Agency securities, which is what I've been saying for the whole show, which is basically rates are going to keep going down and stay very low because the government needs the debt to stay low because they don't want to pay interest on the $100 trillion they're going to owe, counting unfunded liabilities. The other thing that was that interesting, Kathy Wood talked about technology. So I just want to mention this short story. So this is just a perfect example of why I'm not concerned about labor at all, because of robotics and technology, which is very anti-inflationary. But so I needed certain foot inserts, and I couldn't buy them online. So I had to go to 4 CVS's in Stamford area, basically, near where I live. So I went to all 4 CVS's. Every one of those, when I went to checkout, there were 4 automated checkout machines there. One of them, the nearest person was across the store, a CVS store, and the other ones, there was like basically nobody there. They're not even watching the machines anymore. So at each one of those, though, at one and where I had trouble, 2 of them, the machine started saying, "You need help. You need help," something like that, and somebody from across the store came over. So the other one, the one person manning the 4 machines, helped me out. So, but basically, this is the future, because now the machines are doing the work, and so retail store positions are big positions, but yet, and you need people, but you don't need as many people, because all of a sudden these cashier jobs go away. And when driverless vehicle hits, that's it for the labor force, because 11% of people in the United States, and I'm sure it's similar in most countries around the world, make their money driving. But we're going to have cars, and it's already in existence now. They're experimenting with them in a few cities. They're doing tons of runs, thousands and thousands of runs with these. And you call them, and there was a Domino's pizza truck, by the way, in an ad that delivered, that's on TV. So now you're going to call your Uber or whatever you use and your cab, and it's going to come to your house, and it's going to pick you up and bring you wherever you want, and there's not going to be a person in there. So those 10% of jobs are gone, and you don't need to buy an auto necessarily, because now, maybe you buy an auto, maybe you don't, but maybe you don't need an auto anymore. So this changes the game for auto manufacturers, and for a lot of labor, and it's going to continue, because these machines are so smart. And I've already talked, by the way, about the waiterless, the laborless store in Fort Lauderdale, which I'm going to visit maybe when I go to Florida next. And it basically, you get to the restaurant, and the machine greets you, and then another machine meets you at your table and takes your order, and then a third machine brings your food. So
Fantastic.
So what are people going to be doing? I'm not quite sure, but I'm not worried about labor in the medium term to long term. So I think energy will be an issue, so that'll drive costs up, and printing money will be an issue. So there will be some inflation, but I think rates will stay low for the rest of our lives.
Yeah, Peter, a very good observation. And of course, Uber will be among the winners if
you're right.
become popular.
And I'm not in Uber, but you're right, because think of how much money they can make when they can get rid of their labor.
Yeah. Let's take a 1-minute break, and we'll continue right after that.
Yeah.
Okay, let's continue our discussion. And of course, one of the most probably promising areas has always been is energy sector. The energy is going on a rip, and I don't see what will stop oil going to $100 a gallon, a barrel.
Yeah.
If that's the case, then all energy companies should prosper from that. Anywhere from Exxon to Enbridge to just any company, probably even MPLX should do quite well.
Oh yeah,
It's doing well anyway, but
yeah, the pipelines, by the way, correlate with oil prices. Even if they're natural gas pipelines, there's a high correlation because I
yeah,
guess they're maybe held by funds that own both. So they sell off the oil, they sell off the pipelines. It's ridiculous, though. When you look at a pure natural gas pipeline, that correlates with the price of oil. But that's an arbitrage too. But no doubt about it. I mean, look, every day I hear more stories like this. I've been saying this for months that energy is going to be where the money's going to be made. And so, first of all, oil prices now is like $83, $85 a barrel, I think now,
and
and
it's staying there.
natural gas is around over
Yep.
$5 a million BTU, and it was up from under one. Around under two, I should say. So, but it's natural that it happens because one, if you look at all the incentives, so if you're an oil company like Exxon, they're looking right now at canceling projects because of ESG, the environmental concerns, because it's just sort of an excuse in a way because they're saying, look, if maybe we'll be in business 10 or 20 years, but we're not going to over explore like we've been doing cyclically forever and drive the price down and drive it up and drive it down. So they want high prices because maybe they are in a 10 or 20-year run where they need to return dividends, to shareholders and buy
Right.
back shares and they need to adjust. So they need high prices. The
Peter,
Democrats want high prices because they want the shift, reasonably towards natural fuels. So, replacements, carbon neutral things. So they're going to want higher energy prices. And if you're OPEC, you definitely don't want to do what you did before, which is Trump asked you to bring in more production. They did it, and then they crashed the market down to 40. They can't afford that. And also, they might be looking at, look, if we're going to be in the oil business 20 years or 30 years or 10 years, what are our kids going to be doing? We need to make some money now. So we're not going to drop the price. And then you have pipelines that are being canceled. You have government policies that are very negative towards energy in the United States. So everything tells you, why would it go down? It's just, it has to go up because almost everybody wants it to go up. Now, the Democrats don't want it to go too high because it's going to hurt them politically, although they're probably already slaughtered politically. But one last point, which I was going to see if I could bring it in, but since you bring up energy, this is really interesting. So TRP, first of all, one of my holdings, I have about now 7% because it keeps going up, said that by 2050, they would be carbon neutral. So this is the new thing with the energy companies. Let's say you're an energy company. You say, okay, I'm going to start investing in carbon sequestration. And maybe that'll help a lot in terms of, becoming carbon neutral. But here's the interesting thing. And this is a pretty amazing chart. I just saw this today in the New York Post. I don't know if everybody could see this or not, but you could get a picture of this. So you see those two charts, the ones, all you have to notice, and then I'll talk about it, is you see those ones that are all going down, and then you see these two that are skyrocketing.
Mhm.
Well, this is per capita carbon dioxide emissions from 1990 to 2020. Well, you look at the United States, and it's gone down since 1990. It's actually slightly a bit lower than it was, and it's been going down pretty steadily since 2012. You look at the Germany down, UK way down. Oh my gosh, UK has gone hugely down. But then you look at those two up here, those two, and that is, guess what? China and India. So the Chinese and Indian per capita, and these are huge populations, has grown more than 200% for China and 200% for India. And a lot of that growth has happened since 2005. I mean, if you look at this chart,
Yeah, you can see this.
you could see this angle. It's like
Yes.
boom. So these countries now, some of that was maybe a shift in manufacturing, but it's mostly the fact that they're developing and they're using more energy and they're just trying to be economic, but they're using coal way too much. And even India only had 4 days of coal supply about 2 weeks ago. They were running out of coal. So anything that's done in the United States or in Europe to control carbon is pretty much irrelevant if they don't get China and India aboard. But from the Chinese and Indian point of view, they're saying, well, we have people to feed, and we don't want a revolution, and we want to. So they're maybe not going to jump on board this, and so it's pretty scary if you believe in global warming being damaging. And I'm kind of mixed on it, and I know it's going to do some damage, but if you really think it's, the planet could be endangered in 30 years, 50 years, 100 years, then China and India don't get aboard. You're wasting your time.
Hmm. Well, we have a comment here that that was wrong news about Indian coal supply.
Oh, really? They
Yeah,
weren't running out of coal?
well, I don't
It's
know.
possible. You know what? They're still using a lot anyway. And I know that was just part of one story. They said Germany was almost out of natural gas. I mean, the reason the prices are going up is because all over the world is basically because there's demand that's exceeding supply. But it may be untrue about India. Maybe they weren't running out. Maybe that is possible. I just get my news from news sources, so I
Well,
try to use
maybe a
reliable.
while ago they were short of coal. Maybe they figured out how to
Yeah,
release.
no, it's possible that it was a fake story, and even I try to use very reliable sources only,
Hmm.
and not not ones I don't trust at all, like
Sure.
CNN. Like CNN, I would never rely on. I look at them sometimes, but I don't trust them. But but maybe that story was not true. In any case, though, they're still using a ton of coal. It doesn't change the point, and so is China. And if they keep using this coal, then the environmental factors, are not going to be mitigated by the United States, which uses less, or Europe, which uses a smaller and smaller percentage anyway because of technology. So it has to be a worldwide effort, or else it's useless.
Yeah, and the coal, I think the greatest disadvantage of coal is a transportation problem, that you have to transport it for hundreds of kilometers at least from where it's been um, developed to end user. It's
And it burns, but it doesn't burn as clean either. I mean, there's no, they
absolutely.
say clean coal, but that's only relative to dirty coal. But it doesn't match
Mhm.
like natural gas, which is why I try to focus on only natural gas companies or almost pure natural gas companies, which have been doing tremendously well, obviously, because like an MPLX, which by the
Uh,
way,
So speaking about strategies, how we can use this data, uh, I would probably think about selling puts on Exxon and a couple of other companies that we mentioned,
uh,
with the idea to, if you are exercised, to acquire more shares at much cheaper price, and if not, you just keep the money on your account.
well, you know what? I looked at Exxon a lot because you're right. Selling puts on Exxon might be good, but for me, the problem is I'm 25% or more. I'm more on energy now because energy went up so much. So I have, I don't know, like 20% in MPLX alone. I have to look at it, and TRP is big. USAC has been doing well, but these are all natural gas. And I say, which would I rather have? An Exxon Mobil that does, a mix of oil and natural gas, or just pure natural gas. And I'll stay with the one that in 50 years 30 years, 50 years is probably going to keep growing, where oil could do anything. It could be flat over the next 50 years. You're trying to get rid of that oil as a fuel. So I don't know if they'll be successful or not, but there's risk there. But natural gas, I don't think they're going to touch it, not for the next 30 to 50 years. And all projections show growth in the industry, significant growth. Like if you look at EIA projections, the U.S. Energy Administration, everything is natural gas up. So why be in a flat industry when I can be in a growth industry? But if I was going to add an oil company, it would be Exxon. And maybe you're right. Maybe we should do puts on them.
Peter, when you're talking about the percentage of your portfolio devoted to either one industry or a certain stock like MPLX, it always brings memory to me. There was a Canadian company by the name Nortel Networks
Oh,
in the
yeah.
late 1990s.
Mhm.
And the story was interesting that Bell Canada, which is very solid, it's a stock for for widows and
Yeah, I
orphans,
have BCE.
and paying very good dividends.
Yeah,
Very,
it's been very nice, steady growing dividend. It's very healthy, along
but
with
that was
TELUS.
what happened at the end of the 90s. Bell Canada owned 60% of Nortel.
Mhm.
Nortel was highly speculative stock, of course, at that time. And many fund managers, they were using very sound strategy. What they did is of course, some of them were owning Nortel networks outright, and
Mhm.
they were making a lot of money. But they had a problem that more and more percentage of their portfolio, they couldn't exceed 20% on any single position. And at one point, Nortel went up so high and so
Uh,
quickly that they were sitting on 25%,
yeah.
30% of their position. So how to mitigate that? So what they found a solution. They were shorting Nortel networks and going long on Bell Canada, which owns 60% of Nortel. So essentially, their play was it doesn't matter how high Nortel will go, but Bell Canada will go higher as well because it owns 60%
Right.
of
So that
Nortel.
mitigated. But you're right
So
about
that is
portfolio
mitigated.
exposure.
And
You don't.
and and,
You know,
and you know what was the end of story?
right.
So they see, unfortunately for them, Bell Canada was going higher, but
Mm.
not nearly enough to offset their short positions on the Nortel. So they were creamed. They
Yeah.
just had margin calls, and they had to close the position.
Again,
They
this is
bought.
speculative, but you know what the difference is for me? I believe, and I can be look, I've been wrong, but I've been right a lot more than I'm wrong. But I view the natural gas as utilities, basically the pipelines. Look, there's demand pull. It's not push, it's pull. So people, as long as they need to heat their houses, unless there's a good substitute, these companies are going to just keep pushing it. Plus, they have long-term contracts. So I don't see a lot of risk in a TRP or a USAC, which makes the motors or
Absolutely.
whatever, because people need to heat their houses. I mean, it's a utility, but it's priced with huge, rates of return, huge cash flows. I guess we better get to dividend stocks, and we'll cover crypto
Yeah.
next week. By the way,
Before you do that, I just wanted to remind everybody the end of story of Nortel. It reached $140 a share, and then it bombed down to 36
yeah,
cents.
you never know. You
Yeah,
never know.
you never
That's
know.
but you know what? At some point though, when there's no substitutes, again, I'm 50% bonds maybe, and then I'm maybe a quarter tech too. So I mean,
It's interesting, Peter. I had a
yeah,
friend of mine at the time who, when Nortel was going down all the way, and it
yeah.
reached $50 a share from 140. So I had a friend of mine. He said, "I'm going to take mortgage on my house, and I will buy it $50
Uh-oh.
as much as Nortel as I can." And I asked him one question: what makes you think that Nortel cannot go down to $49?
Right, right.
Because then you'll do much better by at
Did
49.
he do it? Did he do it?
uh, he started to think about it after
Oh, he
what I
slowed
told
down.
him.
Yeah, yeah. I
As
had
a
a friend back in
next,
the 1999, around there 2000, and he said, "I'm going to put a lot of money in tech because it keeps going up." And he hadn't invested before. I said, "You know what? You'll be the last person to get into tech, and then it's going to smash." And he was basically. He got in and he just got creamed. So you need diversity in your portfolio, but again,
absolutely.
you know, I mean, I view it. I protect some of these positions with options, but it's very hard. When there's so few alternatives. Look, I'm getting 9% on MPLX today, as an example, and they're going to come out possibly with a dividend increase announcement today or tomorrow. I wouldn't be surprised, and I wouldn't be
Absolutely.
surprised. But again, I try to look at the risk, but I don't see that much risk. And if I lose it, I lose it. But the other side is, where am I going to get any returns anymore? Towards the future income and everything, and it's very hard. So
Well, from
today
trading
I bought.
MPLX,
Yeah.
Peter, I see the trading risk on MPLX. The bottom floor is about $27 a share. It cannot
Oh
go.
yeah, I don't. You know what?
And
So
that,
I'm holding it for life. One and two.
absolutely.
I've looked at accidents in the industry, by the way, because that was a
Mhm.
fear. It's like, what if there's a big accident? But they're not waterborne. They only have one operation, and from what I could see, it's only ferry boats on the Mississippi, and those Mississippi ferry boats are very small. So if there's an oil spill, it's not like an Exxon Valdez.
Yeah.
Because I was thinking, well, what if those ferry boats had a spill? That was the only. But other than that, it's like basically there's a huge company, and TRP is a huge company. I mean, these companies are supplying a good part of the U.S. natural gas, and USAC is supplying a good part of the motors for all of the heat of the United States, Canada, Mexico. So these are big companies. I think they're safe. I hope so, and I think
So
so.
speaking about stocks, these two are obviously top picks for dividend stocks, and there are very solid companies. They're not stocks that Cathy would invest.
No,
She's playing completely
no,
different.
she's the opposite of growth dividend stocks. But
Absolutely.
but history shows that dividend growth stocks particularly outperform all stocks. Dividend stocks perform all stocks. Dividend growth stocks perform even dividend stocks. So these are great companies. And it's, I was thinking the other day, and then I'll get into one, that, among several advantages of dividend stocks is, let's say I'm getting 5% of my portfolio and one of my stocks bombs. Well, you know what? I get the dividends and I can just reinvest in the next company.
Absolutely.
So if you get no dividends, you're out the 5% and hope, then you hope the rest of the market goes up. But this allows me to just go to the next investment. So, there's a cash flow is good. So this week I bought, or last week or so, I bought into a stock, and I just view this as a bond substitute because I don't think long-term rates are going to go that high. Maybe the 10-year will go to 2% next year, I think, maybe.
Right.
And then the market will get scared. Oh, no, interest rates are going through the roof. But again, because of technology, demographics, because of government debt, it'll all just settle in at some point and go back down. And, if it goes too high, the economy will get crushed, and then they'll bring it down anyway. So I look at this. I only put 1/3% of my portfolio in this. It's a open air shopping center, which I like. I never liked the malls for the last few years, but open air shopping centers had some good opportunities. It's called UBA Erstad Biddle. It has a 4.6% yield. It's covered by its cash flow. And this is tricky because TD Ameritrade and E-Trade had two different numbers for price over cash flow. Yeah, they don't always agree, but sometimes they go with the average. So the average, let's say, is 10% cash flow yield, because they were almost opposites at 13 and 7. But, maybe they're looking at different time periods. Who knows? But either way, they've held their dividend through this last crisis. Their debt to assets is only 0.3. And what it is it's shopping centers in the tri-state area, just in the suburbs. So I live in Connecticut, and along the shore here, they're very wealthy communities. And the same thing in New Jersey and Long Island. Their income in their communities is 70% above the national average. And there's very little space for a new shopping center because it's so expensive for land. So they kind of have a somewhat of a monopoly. And these are all basically grocery oriented, pharmacy oriented, or wholesale, like Marshalls, things like that. And I go to some of these in Connecticut, and some of them are flooded. And so they're doing fine through the pandemic, and they just, pumping out 4.6%. So again, I wouldn't put too much in there because they haven't grown their dividend, but they have the potential to do it with their cash flow. And it seems like a safe place. Again, part of a diversified portfolio, because I can't be all tech and energy on my stocks.
Absolutely.
And I want to, have steady income, wherever I can. And I do, and it'll do very well if interest rates keep going down over time, which I think in the next year or two they'll start dropping again.
Excellent, Peter. And of course, that corresponds very well with our major policy, is preservation of capital. That's the name of the game. The problem is that without capital, you cannot invest, you cannot do anything.
That's true.
So preservation of capital is the most important thing. Peter, thank you very much for your contribution today. And we'll see you next Wednesday. And hopefully we'll have some new ideas by that time. Good luck on the market, everybody. It was IBM TV, a financial show, Modern Investments. Thank you very much. Bye-bye, and see you next Wednesday.
Bye-bye.
Bye-bye.